We often hear that the typical millionaire diversifies their sources of income into around 7 different streams, while most people rely exclusively on the salary from their main job. This single-minded dependence can leave them vulnerable to financial instability, since losing their job or facing an economic crisis can directly impact their ability to support themselves and their family. These different sources of income vary in terms of activity level, passivity, taxation, and leverage potential. Today, we're going to explore the 7 main ways in which most millionaires build their wealth. But before we start, don't forget to like this video and subscribe to our channel for more great content like this. Let's go. The first and most common source of income is earned income. This category covers money earned through traditional jobs, from regular workers to top executives like CEOs. Interestingly, many CEOs remain employees of their own companies, which puts them in this income category. Professionals such as doctors, nurses, and other service providers also fall into this category. Earned income is acquired by exchanging time for money, which is commonly referred to as active income. This category can also include freelancers who sell their skills and time for financial gain. For many self-made millionaires, earned income serves as the first step on their journey to wealth. It's where most people start and can be a solid foundation, especially if it allows you to cover essential expenses and support yourself and your family. However, relying exclusively on this type of income can be risky. This is because you are exchanging your time, a finite resource limited to just 24 hours a day, for money. Therefore, there is a natural limit to how much can be earned in this category. In addition, the income earned is subject to high rates of taxation, which can reach up to 40% of income, depending on your level of earnings. Although this is a respectable starting point, it is essential to explore other sources of income. The second source of income is profit. This type of income is generated by selling goods or services at a price higher than the cost of production or acquisition, marking a transition from being an employee to becoming an entrepreneur. In the past, starting a business required a significant initial investment to buy goods or services, but today, with the internet, it has become much easier to get started without needing so much capital. Whether selling physical or digital products, if the sale price exceeds the cost of production or acquisition, this generates a profit. This source of income can be either active or passive, depending on the business model adopted. The manual creation of products and sales tends to be a form of active income, which can pose challenges in terms of scalability. On the other hand, outsourcing manufacturing or selling digital products can pave the way for passive income. Profit income can be categorized into 2 forms: small individual ventures and highly scalable companies. The former involves manually creating or selling products, often through platforms such as eBay or Facebook Marketplace, offering an affordable way to generate supplementary income. In contrast, scalable ventures can offer much greater opportunities, allowing profits to grow significantly over time without the need to proportionally increase the time invested. Scalable income through profits arises when a business is established and production is outsourced, allowing the entrepreneur to focus on strategic functions such as sales and marketing. This not only frees up time, but also enhances business growth. Taxation on these profits can vary depending on the structure of the enterprise. Those who run small businesses or create products on an individual basis generally face taxation similar to that on earned income. However, by establishing a business entity, such as a limited company or a corporation, it is possible to exploit various tax advantages. Corporate structures allow for significant tax optimizations, which can result in a substantial reduction in the tax burden. The third category of income is interest income, which is generated by earning interest on borrowed funds. However, it is important to exercise caution when lending money to friends or acquaintances, as this can entail unnecessary risks. Instead, Interest income is commonly acquired through safer and more reliable investments, such as investing funds in bank certificates of deposit, CDs, investing in corporate bonds, or buying treasury bills. These methods are known for offering stability to the investor, although the returns are often modest, usually ranging from 1% to 4% per year. For those looking for higher returns, there are more innovative alternatives, but they come with greater risk. Interest income is considered a source of passive income, as it requires minimal involvement on the part of the investor, since, after the initial investment, the capital begins to generate returns relatively autonomously. The fourth category is dividend income. This type of income is generated from investments in shares in companies that distribute a portion of their profits to shareholders. When you buy shares in a company, you become a shareholder and, as such, are entitled to a share of the company's profits, distributed in the form of dividends, which are usually paid quarterly. As a shareholder, you own part of the company and are therefore entitled to a portion of its profits. Taxation on dividend income can vary depending on its classification. Qualified dividends, for example, may be subject to a lower tax rate. For those earning less than $38,600 in ordinary income, the tax rate on dividends can be 0%, while for those with incomes above $425,000, the maximum rate can be as high as 20%. This rate is significantly lower than taxation on earned income, which can reach up to 40%. The fifth source of income is a rental income. This usually involves purchasing property and renting it out to tenants. However, rental income is not just limited to residential properties. It can also include commercial properties rented out to companies or industrial properties rented out to manufacturers. In addition, there are other ways to generate rental income on a smaller scale. For example, it is possible to rent out equipment for various industries, vehicles, musical instruments, and so on. Essentially, rental income refers to any income earned from providing a property or asset to someone else in exchange for payment. It is a versatile form of income generation, with possibilities ranging from renting out physical property to renting out movable assets. Residual income and royalties represent one of the most valuable forms of passive income, as they allow you to continue earning money even after the initial work is done. This type of income can come from various sources, such as acting in a movie that continues to be watched for years, writing a book that remains popular, or these days, running a YouTube channel that continually accumulates views. Royalties are a form of residual income generated when you allow others to use your ideas or intellectual property for profit. For example, musicians earn royalties by allowing streaming services and record labels to distribute and sell their music. Each time a song is played or bought, the artist receives financial compensation. Similarly, authors receive royalties when they publish books, and publishers print and distribute these works, continuing to generate profit whenever sales persist. A single intellectual property can generate several streams of royalties. An iconic example is author J.K. Rowling, who not only earns royalties from the sales of her books, but also from film adaptations and merchandise based on her characters. Even decades after the release of the first book in the Harry Potter series, Rowling continues to receive royalties every time someone buys related products, rents or streams the films, or acquires the books, a testament to the power of a successful original creation. The seventh form of income is capital gains. These gains occur when you sell an asset that has increased in value over time. Real estate and shares are the most common examples, but many other assets can also generate capital gains. For example, if you bought a property for $180,000 and sold it for $250,000, you would have realized a capital gain of $70,000. Similarly, if you acquired 100 shares in a company at $20 per share and sold them at $120 each, this would result in a capital gain of $10,000. It is important to distinguish capital gains from a profit income. While profit income involves the purchase or production of goods for resale at a higher price, capital gains result from the increase in value of assets over time. Although the control an individual has over the appreciation of these assets is limited, capital gains enjoy favorable tax treatment compared to most other types of income. Capital gains tax rates generally range between 15% and 20%, with the possibility of a reduction to 0% in certain circumstances, especially in real estate transactions. In many cases, reinvesting capital gains from real estate back into the market can allow for tax-free growth, helping to increase net worth without incurring immediate tax burdens. And with that, we conclude today's video. I hope you have found the information useful and that it has been beneficial to your understanding of how to diversify and increase your sources of income. If you enjoyed the content, please don't forget to like it and leave your comments. Your opinions are very valuable, so feel free to share your thoughts in the comments section below. Finally, don't forget to subscribe to the channel and turn on notifications so you don't miss any of our upcoming videos. Thank you very much for watching, and we'll see you in the next one.